Hi, it's Mike Swanson again, and this is going to be our last video about this bear market, or in this series at least. And it's going to be about what you should do, how to survive and how to profit in a bear market. Now, the most important thing you should do is have a core position. Now, normally you go to a stockbroker, investment advisor, he's going to sit down with you, he's going to say, well, let's put you in these mutual funds here and diversify. Let's buy a bond fund, let's buy a mutual fund invest in stocks. Hey, let's roll the dice and do one in international markets. But however he positions you, he's going to say this portion of the fund is your biggest position. It's your core position. The way they usually do this is if you're under 30 or under 40, they'll say that position should be in stocks. Your core position should be a mutual fund in stocks, and the other stuff's going to be smaller because you're looking at a long-term time horizon. Stocks go up forever over the long term and so forth, and you want to retire and get rich, and so stocks is where you are. If you're older, they're going to say you need less risk, so let's put more of your money in bonds. Well, what I'm going to tell you is that this is a bear market, and you ought not do neither one of them things. What you ought to do is have a core position called cash, so that you can use it when this bear market is over and deploy it into stocks and to the broad market when the next bull market truly begins. And if you want to take the least amount of risk as possible, then you should be 100% in cash and just ride this all out while everyone else suffers through it, and you'll be sit there clear-headed when it's over and ready to deploy your capital and ready to sit back and enjoy the next run. Now, if you want to make money, you're going to have to be a more apt trader, and I emphasize the word trader now, not investor, than you've ever been before. You're going to have to sit down, you're going to have to study how to time the market so that you can short rallies and get out when you see panic in the market and sit back and wait for another rally, short that, and ride that down. And then you're going to have to learn some timing techniques so you can spot the 2 or 3 sectors that still remain in bull markets while everything else goes to the crapper. And right now, the only sectors that are still in bull markets are commodities. Gold, precious metals, oil and energy, and some agriculture things. But the problem right there is that we had such a tremendous run in commodities as a whole that it's really difficult to get in those sectors right now, and I'm not recommending that you do. In fact, if you got oil and so forth, you probably should have sold it or be taking money off the table for a pullback and then look to get back in later. I do believe that we're still in a long-term bull market there, but you do get your dips every once in a while. Gold I think probably has the most potential right now to go up for the rest of the year. Gold hasn't gone up as much as oil did, as much as the other commodities did, and gold tends to trade opposite the dollar, which is still in the almost curse right there, but the dollar's still in big trouble. And gold's going to be the big beneficiary of that. We did see a giant surge in gold prices since August to about the end of January, a dip, then another surge up. But gold stocks as a whole have pretty much lagged. I mean, they did go up, but they didn't go up as much as they had in the past when you've had tremendous runs in the metal. So I do think there is opportunity there, but right at this moment, I'm really uncertain about what gold and gold stocks are going to do in the next couple of weeks. And I feel more certain that they're going to go up from now to the end of the year. So that's something that I only own about, let me think here, how my position, I got 3 junior gold mining stocks that I think are really great long-term investments. I'm not going to talk to you about them because they're small cap stocks, and I'm not interested in telling thousands of people about them and making them go up and having these people panic out because they're just buying them on recommendation and not on any real research of their own. Save such stock picks for the website where people, there's fewer people for one thing, and then the people tend to have more expertise than the general public. They've been educated on how to invest by myself, and if not by myself, then they've got pretty damn good experience investing themselves. But anyway, I'm going off on a tangent. Bottom line is, what you need to do is not be afraid to have a core cash position, and if you want to venture out, you do so with a very small portion of your portfolio, and you can venture into some of the more speculative sectors, gold I mentioned, or you can do some market timing through short selling when you get some nice rallies like we had up to the 200-day moving average. And I explain to you in the second video in this series how the 200-day moving average acts as resistance during bear market. So when the market rallies up to that level, that's where you take short positions, and you cover when the market drops and you have a wave of panic as everyone dumps their stocks because they get scared because they decided they're going to hold on and ride things out, and bam, now they sell. And that's when you want to cover your positions and buy from the selling public. And not just the public. I'm not trying to put down the little guy. It's the professionals who are probably even stupider than the general public, who are really responsible for a lot of the mess we're in right now. It's the professional money managers who bought up the stupid subprime mortgages a year ago and been blowing their hedge funds up ever since. And of course, look what the banks have been doing. Bear Stearns went bankrupt, and they thought they had the smartest traders in the world. Well, as I explained to you a little bit in the previous video, people don't really behave based on logic in the markets. They behave on their subconscious fears, and then they rationalize their behaviors using their faulty logic. And that's not what you want to do. And I think I've done a good job with you talking about this bear market and what caused it, what made me identify it back in October, what signs from a technical viewpoint I believe we'll see when it comes to an end, and then from a fundamental viewpoint, my guesstimate of the first quarter 2009 of when we'll see these signs. But even though that's my belief, I'm going to be using the charts and the indicators to actually prove those beliefs to me. I'm not going to trade in the manner of using my subconscious fears to make me do actions and then use my faulty logic to justify my actions. Instead, I'm going to say, I think logically, based on the way the economy is situated, we will see this. If we see this evidence in the future, I will then believe the market has bottomed, and then I will then act on it. Use the evidence, use reality, not your simple subconscious fears or whatnot about money, about, you have to do this and that, or else you're going to lose clients if you're a professional investor, and so forth. So anyway, I think I've pretty much done a good job with these videos, and I'm probably going to go away from a while as far as making videos and be real busy on the website, working on some things the next couple months. I'm going to take a vacation at least once during the summer, maybe twice, and I probably won't be doing any videos for quite some time. But I think I prepared you for what I expect we'll see over the next couple months, so I don't really think there's going to be too much more to talk about except take away what I told you and learn from it and act on it. So I'll be talking to you later, and have a good summer.